Welcome back, everybody. It's good to have you. About 3 weeks ago, I said the Milwaukee real estate market is slowing down. It is softening. And some people were wondering if I called it too early because 1 month is just a data point, but I would say 2 months is definitely a trend. So today we have more data to substantiate that, and I can say we have definitely reached a turning point in the Milwaukee real estate market. It is a change in direction, and we can see that. Today I have two big topics. One is that I want to talk about what are the big forces shaping the market at the moment, and then the second big question is what can we expect from the near future? What is the likelihood that we're going to see a market correction? But before we get there, let's take a quick look at the latest data from the MLS. You can see inventory is up just a little bit, plus 17%, and that is roughly what we have expected and anticipated. Still very, very low if you compare it to May 2015, almost 13,000 units in a normal market. So yes, inventory is slightly up, but we have to keep things in perspective. There is still very few houses to choose from. And consequently, you also see them going very fast. So only 4 days on market in median to get a house under contract. And with that, sales about flat, a slight minus here, minus 2.3%. Prices up 11.5%. So for the Milwaukee market, we're not used to seeing home appreciation on that scale. So, another year, this is remarkable. We're up 11.5%. I think inventory is going to continue to slightly increase. And at the current pace, we're seeing an addition of about 500 units every month. We might get back to pre-pandemic levels, which was about 5,000, 6,000 units. So we might see that by early 2023. So that's still a very low inventory level, but nevertheless, it is a turning point. It is a change in direction. Market is still ultra competitive, especially for what I call 5-star listings. So really nice house, well priced. It is going to take 10% or even more over asking price to get that thing under contract. There's going to be multiple offers and you have to compete with. Where I'm seeing the market softening is with what I call 3-star or 4-star listings. They're not as nice. Maybe they are overpriced a little bit. You see those go through a price reduction maybe before they get under contract. So the buyers are still willing to pay top dollars for properties and they're competing for really nice properties. But if a listing is not that nice, it may take a price reduction. We also see the buyer pool shrinking a little bit because a lot of buyers they're fatigued from competing in this market, and also with the rising interest rates. So we're seeing a reduction there, but demand is still much, much higher than supply currently is, even though we are seeing a reduction there. I want to take you back a little bit into context for inventory, because I think that is so important. When people say, oh, inventory is up, you have to understand what that means, because it's really the magic of small numbers. And you can see here 2022, we're at about 3,200 listings. Going back to 2015, it was about 13,000 listings. And back all the way to 2009, so that was in the wake of the mortgage crisis, housing market crash, we had about 17,000 listings in May, and we're almost touching 20,000 here. So you have to keep things in context, and you can see here still with an increase of inventory, we are still very, very low. Latest inflation numbers came out just a day ago, and this is month 14 of elevated inflation. We are now at 8.5%. If you look back historically, most times in the US when we had inflation, it was a situation that took about 3 years, maybe 4 years to correct. And so we're now 14 months in. I'm not expecting this to be corrected anytime soon, so it may take us another year before we get out of this situation. And home prices, when you look at them net of inflation, haven't gone up all that much, because there's really two ways you can look at inflation. You can say, oh, all the prices are going up, or you can say, well, we've printed so many dollars that the value of the dollar has gone down, so it takes now more dollars to buy the same goods and services. And real estate is traditionally a very good hedge against inflation. So this is why we're seeing what we are seeing currently. This is a chart you've seen before, and I keep getting the question over and over. So I wanted to show this again. What is happening to real estate prices if we are going to get into a recession? And you can see here the last 6 recessions, we only ended up in the deep red one time. That was 2008. And quite frankly, that was a mortgage crisis that caused a real estate market crash that ultimately caused a recession. So it was not a recession causing the housing market to go down. It was the housing market crashing, and that caused a recession in the wake of that. Every time we had a purely economic recession, the housing market either went sideways, minus 1.9% in my book is pretty much sideways. That's not a correction. And in the other 4 occasions, we actually have seen increases in home prices. So from an historic point of view or standards, a recession does not automatically mean that house prices are going to go down. So when we look at the current marketplace, we are not seeing many changes in supply and demand. That stays relatively the same. We still have that massive imbalance. You can see it when you're driving around in Milwaukee. There is not too much new construction, so the supply side is relatively flat, and the demand side is certainly also not going away. So what's changing and what's impacting the marketplace are the mortgage rates. And you can see this here on this chart very easily, how dramatic the change has been. There is a popular saying amongst mortgage bankers, and that goes, when rates are going up, they take the elevator. When rates are going down, they're taking the stairs. And this is a perfect illustration. You can see how long it took for rates to actually come down and how quickly they shot up taking the elevator here. So it's no wonder that this left the marketplace in some sort of a mortgage rate PTSD syndrome. So everybody has some sort of a sticker shock, and it will take quite a while for everybody to get adjusted to that. Now, the question is what's going to happen in the next few months in the real estate market. And in my opinion, that is going to depend what mortgage rates are going to do. And I have a chart here that shows rates from the beginning of the year, and they shot up pretty much in a straight trend line from 3% to a little over 5%. And the last 5 or 6 weeks, they have been kind of plateauing off. They have been going sideways. And there are a lot of mortgage experts that are predicting that rates are going to stay around that range. And there's different schools of thoughts. Personally, I would actually not be surprised if we are seeing mortgage rates at about 5.5%, maybe even over 6% by the end of the year. And the reason why I'm thinking this is because the economy is still running way hot, and the Fed will have to keep tightening the screws in order to cool off the economy, possibly get us into a recession in order to get inflation under control. And that's their top priority. They have to do that. So for that reason, I am not going to be surprised if rates are going to go up. But that is not necessarily the worst thing, because when you look at what's happening with rates over the last 50 years, you can see that the housing market in the US has lived very well with rates much, much higher than they currently are. And not only lived with rates, the housing market has actually thrived with rates like this. But when you look at the market currently, about half of the buyers, more than 50% that are currently in the market, are millennials. So this is the first time around in the marketplace. They have never seen rates that are much more than 3.5% or 4%. So when you take that perspective, it is no wonder that this is a big sticker shock, and it will take a while for them to get adjusted to the new normal. But I also think that we have to keep the bigger picture in mind. And when you just look at what rates do actually to the marketplace, and you look back in history, we have seen rates much, much higher than what we currently have. And the market has done very well. So why is it so difficult to anticipate where mortgage rates are going to be? A lot of people are under the impression that the Fed is setting the mortgage rates. And that is actually not correct. It is the marketplace that is setting the mortgage rates. The Fed is only setting the interest rates for the banking system, but it is a mortgage rate marketplace that is defining the rates. And so what is happening when the Fed was announcing early this year that they're going to hike the interest rates in multiple steps? The marketplace priced it already in the mortgage rates. And this is the reason why I think a lot of experts are thinking that rates may have some room to come down a little bit. So here you have a chart that shows the correlation between the 10-year treasury yield, that's the blue line, and the 30-year fixed mortgage rate, that's the green line. And the average spread between these two lines all the way back into the early 70s was 1.7. When you look at what's currently happening, then we have a bigger spread between those two lines at the moment. at about 2.2. So between 1.7 and 2.2, there is about a 0.5% point that mortgage rates are currently a little bit fluffed up. And that's why experts are thinking that we may have a little bit of room there for mortgage rate softening. So that's the reason why it is so difficult to anticipate what's going to happen. But one thing is for certain, what mortgage rates are going to do in the next few months is going to determine the second year of the housing market here in the US. Perfect segue to the second question. Are we in a housing market correction? It certainly feels that we are due for a correction. And that is a question that I get asked by almost every client. And we are currently not seeing that anywhere on the radar. So first of all, the definition of a correction would be a decline in home values of more than 10%. And we currently do not have that on the radar. In fact, just the opposite. I have here the latest version of the home price forecast for 2022. If you're following my channel, you're familiar with this chart. The bar on the left in green gives you the average of all 7, and we are still predicting an increase of 8.9% this year. So this is down a little bit from 9.0 last month, but we're still expecting home prices to go up 8.9% this year, even with the slowdown in demand and even with the higher interest rates. So demand is still very, very strong. And here's a chart that illustrates it very well. This is the showing traffic index from showing time. And you can see here that the buyer demand has been quite a bit stronger in the last 2 years than it has been in the pre-pandemic demand. And even though this is coming down, we are still very, very strong on the buyer demand side. Here's another metric that I pay a lot of attention to on a daily basis. So when I'm writing an offer on a property, one of the first things I want to know is how many other offers I'm competing with. So I'm keenly aware of this. All agents, or most agents, I should say, are. And this is very, very important. So average in the US is still 5.5 offers written for every house sold. So this is why it can be so frustrating for buyers, because you have to find a lot of houses, write a lot of offers to get one on the contract. And this is going to be one of those indicators that are going to tell me in advance, a leading indicator that is telling me when the market is slowing down. So in Wisconsin, we are currently here on average at about 4 offers written for every house sold. And we will pay very much attention to where this number is going, because that is a leading indicator on where the market is going. But so far, we still have a lot more buyer demand than we have supply from sellers. But it is slowing down, and you can see this here in the revised number of the overall home sales forecast for the US. So we're now predicting only in quote marks 5.6 million homes sold for this year. So this number used to be higher. It came down. It has been revised down because of the higher mortgage rates, but we're still way above pre-pandemic sales levels. Finally, here's a quote that I wanted to share with you, because I could not agree more. If you are looking to buy a home, I would still recommend to do so, even at the higher interest rates, because we have no reason to believe that home prices will stop appreciating. And here's the kicker. Home values going up is only a problem when you're trying to buy. When you own a home, it's actually a gift. So this is very, very true and something to think about. All right, let's take a look at the crystal ball. What can we expect for the next few weeks for the Milwaukee market? So we're headed into the summer market, which is usually a little bit slower around 4th of July. People are thinking about up north and summer vacation more than buying houses or selling houses. So we usually see a little bit of a slowdown for the summer season. Home values may have already reached peak for this year, but we are going to see inventory grow slowly also over the next few months, just like we've seen it this month. So if you're on the buying side, that is good news. That means more choices and a little less competition than you have seen in the last couple of months. 5-star deals will still go very, very competitively. So 5-star are like houses that are super nicely redone, new kitchens, bathrooms, and that are priced very attractively. They will continue to get a lot of attention, and we'll see multiple offers, probably around 10% over asking price. At the same time, we're seeing the market softening on the what I would call 3-star listings. So not as nice of a house, not as good of a location, maybe a little bit overpriced. Maybe the seller was too confident with the price, and then the market will just ignore that listing and force the seller into a price reduction before they ultimately get an accepted offer. So that can also be an opportunity if you are a buyer. And the market will probably accelerate again towards the end of the summer. So back to school time, we usually see the market heating up a little bit for a second run of the year. That's all I had for you today. If you have any questions, you know how to get a hold of me. Always love hearing from you. And with that, thank you very much for watching. I'll see you next month.